Hey there, welcome to the Ryan. Do we have an official name for this yet?
No, but we should come up with one.
We need one.
Should fall in line with the music intro because that thing just fires me up. I just,
Right.
smile on my face. I am just so amped up right
It,
now.
I love that, man. It's fitting for this kind of market too. This isn't like a jazzy little stroll intro. I mean, it's like white knuckle. No, just kidding. We're fine. Hey guys, welcome. Welcome to the Thursday live stream yet to be named. I am Todd Gordon, co-founder of New Age Wealth, with my partner Ryan Bouchey. Ryan, good day to you, sir.
Good day to you. Good to see you. Welcome back. Good
Thanks,
to have you
man.
back.
Appreciate you covering the ship while I was gone. Yeah, it's been a while. Last time we spoke, I was in Park City, Utah. Planned ski trip, and then an unplanned trip came up. Backcountry skiing, helicopter skiing in northern British Columbia. So yeah, tough to be away. And thanks again for covering. It's been busy, but we have a lot to cover in this show. But just to talk about that quickly, it was tough to be away. But right, we've worked so hard to set up the business. The portfolios are in such a position that aside from the communications to our clients and to our prospective clients, there wasn't a lot to do. You're working hard on the planning side, but in terms of adapting, interpreting the markets, I wouldn't have. We didn't do anything. We didn't require to do anything. And I think if you're in a good portfolio, these kind of volatility periods, you don't require to be frantically hammering away at the keyboard, right?
Yeah, that's actually kind of a good lead. I'm actually kind of writing something about that the last couple of days, just in terms of whatever it may be, and not everyone's going to have the same, even maybe the same investment approach. Again, whether you're just sitting in, and I talked about this, someone who's just sitting in the Vanguard All World Index versus maybe having a more active portfolio, but it's just having that disciplined plan and approach, especially when things go sideways, you hit volatility, when you get these world events that you just can't plan for. I mean, you can't, I know there was talks of it, but you really can't plan for a Russian invasion of the neighboring country and what ended up happening and where we're at today. But having a disciplined plan, having an approach, and taking the emotions out of kind of these events and the past 2 weeks especially makes these, you can view them as at times as opportunities, but it's so key to just kind of be disciplined. And I think having our portfolios in place, being disciplined with our approach to the management of it. I was working on a lot of clients with their individual planning, especially with some of the newer clients that we've onboarded recently. But yeah, having the investments in kind of those sound portfolios that again, as you said, they don't need the minute by minute, hour by hour um, manipulation, changing and updating. It gives that, and I think having a team in place to help with clients and help along the way, be acting as a guide through these markets is helpful as well.
Yep. Yep. Exactly. All right. So let's good open there. So obviously there's a lot. We have a lot to hit. We're on a tight schedule. Normally Ryan and I can easily go for an hour. We're going to try to keep 35 minutes, and we're already 5 into it. So we're into 30 minutes. A lot to cover. A lot going on in this market. And as Ryan said, having a plan is super important. Because when things get volatile and when your plan, I think Mike Tyson said you have a plan until you step in the rain and you get hit in the face. Well, that doesn't mean abandon your plan. I never agreed with Mike Tyson on that one. It means that you really have to stick to your plan and adapt only and change course only if there's overwhelming evidence to do so. So let's go through. Let's take you through the way we're seeing the markets. Obviously, a ton going on the geopolitical front, ton going on the macro front. It's certainly a big kick up in volatility, and how do we handle this? So, right, I think you're going to start us off at the top here. What do you want to talk about in terms of Russia and Ukraine? Do you want to get more into the Fed and pricing data, or do you want to touch on Russia and Ukraine? What direction do you want to go?
Why don't we lead in with today's inflation number? Only because it's
Okay.
so fresh. I mean, we've been dealing with Russia the last few weeks. I didn't see anything this past afternoon come through that was, any big changes of what we've been experiencing. So I think probably the inflation number that came out and was kind of obviously a big number in terms of both the size and scale of it. Maybe we touch upon that, and I think that can kind of lead us into kind of the conversations that surround what we're experiencing in the global markets with Ukraine and Russia right now.
Yeah. Okay. Set it up. I'm going to set those charts up in terms of CPI and core, but just set us up. Take us away.
Yeah. So obviously we came in with February's reading at 7.9%. These are the highest numbers we've seen, I think, going back 4 decades now. We have not experienced, and we were looking at the charts earlier today, just the two of us, and we've been in this kind of, even with different market environments and economic events over the last 2 decades or so, but we've had pretty stable inflationary numbers for the past 10-15 years, and all of a sudden we're getting this massive spike. And how do we interpret it? And we were talking a lot about that right now, right? Because obviously the numbers are scary. How do you factor all this in as we're dealing with this global pandemic over the last 2 years? What impact has that had? And then on the flip side, we're getting these numbers that now they're probably driven a little bit by supply, a little bit probably from demand as well, because consumers' balance sheets are in great spots, wages have been on the rise. But how does the Fed interpret all this, and how do they deal with it? And then you throw on top of it all, Russian-Ukraine conflict, which those numbers aren't even captured in this latest reading. So
right,
just
right.
a lot to take in and a lot to digest. So yeah, here's the numbers that in the charts that we were looking at earlier and discussing.
Yeah, and the thing that really I think is remarkable is just less than 2 years back here. So May of 20, guys, we had on the headline reading, we had a 0.12% reading in May of 20, so that would have been Q1 of 20. Borderline deflationary data, and so we have swung so far to the other side. We were talking about negative yields, negative bond yields, not negative real yields and interest rates, but actual nominal negative yields. CPI was down 0.2. Now we went up to 0.7. So I like looking back at here. So I have both the core and the headline. It looks like core only dates back into the 50s, so that's fine. But just going back over the last, let's go back in terms of, let's go back into the 80s here. Let's go 70s. And there's a few things I want to talk about. One of the show notes that we have is just talking about, so many people throwing around the word stagflation, and there's a few things that I want to say on that. But just looking at the core, which excludes food and energy, and Ryan and I were doing some research trying to figure out exactly what percent of the headline number is food and is energy. And the BLS, Bureau of Labor Statistics, makes it kind of a moving target to find. It was interesting. We found data from a couple years ago, but if any of you guys know, please type it in below. We're guessing anywhere from 7 to 20%, and they were saying that they're recalculating the formula for CPI post-COVID because people's spending behaviors changed. But I just can't help but think the spike in headline was significant. We've obviously cleared the 80s and 90s. This was the beginning of the first Gulf War with that first spike. So it's been significant. But then if we go max, it's been a period of very, very flat price growth, really since the 80s. And we're just now seeing the push up. Obviously, this was the stagflationary 70s. This is the Iranian oil embargo, hostage situation going on in there. So we got a pretty big move up. But yeah, it's changed the way we're investing. It's created a big rotation out of growth into value. Put the Fed, back on its heels. We were going to go 50 basis points, but then geopolitical tensions have taken that off the table for the March meeting. And we are going to talk about yield curve as well. A lot of people are saying if the Fed raises, what is that going to do to the economy? And I'm still of the belief, Ryan, that almost every significant market downturn has been accompanied by an inverted yield curve. And I'll show you this in a little bit. But even if the Fed raises, 6 or 7 times, provided the long end of the curve stays where it is, we're still in a healthy shape yield curve, which is bottom left to top right. So we're a long way away from that. So the Fed does have time, or the Fed does have room to move up in the short end before we reach inversion, and the market has already priced that in.
Yeah, and that's definitely an area that's been talking about more than ever, especially in the last week or two, with what's going on overseas. Because and you kind of pointed out with the inverted yield curve and what's kind of some of these indicators that have shown in the past have been leading indicators towards recessions, um, or stagflation, recessions, whatever it may be. But having a spike in inflation that has happened in the past. Inverted yield curve, and we'll look at that in a few minutes. But right now, taking all the data into, you got to kind of put an asterisk next to it to a certain extent, right? Because I don't think this is purely transitory in terms of the numbers we're seeing and the data that we are seeing. But we're in this just different environment that we've ever seen, in going through this pandemic and being so reliant on different areas of the world, right? I mean, and that's something that's newer within the last, what, 2 or 3 decades in terms of being in this truly global economy. And so all these aspects that are happening around the globe can really come back and kind of affect us in terms of what our own biggest companies, how much they sell overseas, being reliant on supply chain, both for goods but also for commodities, in this case today oil, and how we're seeing that be disrupted from the war in Ukraine right now. And so we're just in this different environment, and I really, really do not envy what the Fed is trying to do right now, because they are balancing so many different aspects. And I think it's easy to play Monday morning quarterback in terms of criticizing what they've done in the recent past, and how they're handling it right now. But again, I mean, they're looking at, they get all the data in the world at their fingertips, and it's just been a tough environment, because again, we've never experienced this sort of market and economic environment before. And so as we're coming out of it, obviously, rates have to rise, right?
Yep.
And at the very least, so they have something at their disposal to kind of combat if we do get into any sort of recessionary or slowing down of the economy. We have to get rates up to a certain extent, and so those rates are on the table. I do think it's been good for the market the last week or so, seeing that not to make light of the situation overseas, but that has helped in terms of what the outlook for this first set of rate hikes could be. As you said, the 50s, probably 50 basis points are off the table.
Yep.
Most likely would be 25 basis points. But there is still concern about a rising interest rate environment.
Yeah, yeah. And I think I knowing you, I thought you were going to go down to the Fed's dual mandate, which is price stability, maximum employment. And the recent employment data, we just had non-farm payrolls came out last week while I was away. And solid numbers, the unemployment rate's 3.8%. So we're like 20 or 30 basis points off pre-COVID lows. So what were the figures you said? What are the amount of, how many jobs were lost during COVID, and how many have been filled again?
Yeah, we lost just over 20 million. I forget if it's just over 20, 21 million, somewhere in that range, but we've recouped over 90% of that. We've recouped 91, 92% of the jobs that were lost. And when you look at the open jobs numbers, before COVID struck in February, March of 2020, there were 7.5 million job openings. Today, there's 11.5 million job openings. So you see the market dynamics that could be leading to those wage growths, to some of these inflationary dynamics, because there's been a lot of job creation and a lot of job openings right now.
Yeah.
And maybe there's not a perfect fit for those who are still on the sideline looking for work, and those employers that are looking for new workers. But there's we're still in this really robust, strong job market right now, and that's encouraging. We'll continue to kind of see, and we've talked about it a little bit earlier too, how the pace of wages. I talked to you a little bit about it, that in the jobs report last week, the month-over-month wages started to plateau a little bit, and one side, maybe that is showing a little bit of a slowdown in overall inflation. But as you pointed out too, maybe that's not going to be as good of a thing if we continue to see high inflation numbers and wages aren't keeping up with that. So,
Yeah.
that's a
I'm gonna
dynamic
pop
that I
that.
do think.
I'm gonna pop that chart up right now, and you and
Okay.
I had a nice little debate, and I think I think you and I are on slightly opposite sides of the issue here. They're saying that we need wages to continue to rise on pace with inflation so people can keep up with spending, and you were saying, well, on the other side, if wages don't continue to grow as they have here. I'm showing the chart. I think you can see it. We went from -6% wage growth at COVID lows up to 10, 13%. We've leveled off to 10. So we got to see, is wage growth fueling inflation, or is the consumer ultimately going to be under pressure if their wage growth isn't commensurate with with pricing increases?
Yeah, and I think data like that, month over month, harder to really extrapolate what it's saying, but as we get more data and a longer trend, that's definitely something to continue to watch. I think those numbers are going to be really critical as we kind of see as we keep up. And the good thing is obviously the U.S. consumer makes up like 2/3, I think, of our GDP.
Yep.
Good thing right now is that you know individuals' balance sheets and family balance sheets have been the strongest that they've ever been, kind of heading into this environment right now, going through COVID, with all the concern and all the scares, and I know a lot of people were impacted negatively through it, but as a
Yep.
whole, balance sheets are relatively strong right now, one of the strongest they've been in decades.
Oh, for
And
sure.
does that, if we do see a or divergence from wages to inflation, can that kind of steady the economy through that? That may be something that is a good thing.
Yeah, yeah. Well, one thing that's not seeing price inflation, and two people have come in. I'm watching comments. People are talking about weed stocks. All right, look, guys, we're traders. We're active portfolio managers. The top two comments coming in were weed stocks. Ryan, I'm sorry to throw this curveball, but okay, we're here to make money for our clients. So I'm making a rule here at the NAW, even though this is the new age where cannabis is mainstream. Until this chart starts to turn up, I don't want to hear anything else about cannabis. Okay, I don't care if it's going to explode next year. I'm telling you right now, guys, love you, but stop. Okay, because if we held that in our portfolio for our clients, I think we wouldn't have clients. All right, onward. Let's go to. Do you want to hit stagflation? Is that kind of a nice step to our conversation, or what
Yeah,
on
I
our
know
list?
you had something you wanted to touch on there. I think talking about especially wages as it relates to the inflation numbers right now. I think that's probably a good segue into it.
Okay, perfect. Okay, so I have. Hold on. At some point, right when we get big time, we're gonna have producers for the show. Okay. So people are talking about stagflationary 70s, and this is why this is why we built this company. This is why we named it New Age, because we truly are in the new age. It's not just the new age of the way we interact socially and professionally and the way we consume our news and the way, I think, as a result, markets are changing. There's so much, the pace of information out there is paralyzing to traders and investors. And I'm coming from my prior life, Ryan. I've been a trader. I traded on Wall Street, traded for a hedge fund, traded my own money publicly for a decade. You've run money for in a big established RIA, which is his tune is my crazy customers, and I mean that lovingly because I led the crazy crew. But there's people grasp onto these concepts and these catchphrases that don't really have any rooting in reality, Ryan. You and I were talking about it with the energy situation. We're talking about it with stagflation. And there's just a bunch of concepts and ideas that permeate through the news that should be. And a lot of it is political talking points and campaign promises and how they sound wonderful, but they're not actually rooted in reality, and it distorts the way markets trade. So I think stagflation is the latest one. It's really just been on the scenes in the last week or so, I think. I mean, this is when it's starting to come mainstream. So I started thinking, okay, people are comparing 1970s to today. And I said, well, wait a minute here. Let's talk about this. Let me bring over the chart to start going back into the S&P back in the 1960s. So here it is. And let me flip screen over. Okay, so let me just scroll back here. This is the S&P, and I had it up ready to go until I started looking at crude oil. Okay, so you always have to look at logarithmic charts. So here's the 60s and 70s. 1965, we head into, call it 100 in the S&P. Then we go through, enter the 70s, the lost, this stagflationary, no market movement period. We've got, 15, 18, 20% interest rates. Growth is flat. Guys, the market from 1980, when you and I pretty much came into this world, you're a couple years younger than me, but the S&P was at the same levels it was in 1965 as it was in 1980. With increasing pricing pressures and everything going on with crude oil, yeah, that's stagflation. Guys, look at I'm a simple guy, Ryan. I don't know about if you know that about your partner, but I like to look at pictures rather than read words. That's a much different looking market. Let's go back 15 years. 22, let's go back 15 years to 2007. That's a much different looking stock market. The market has gone from 1,000 to 4,000. All of a sudden, I'm sorry, I'm a little grumpy. All of a sudden, these economic geniuses, everyone self-proclaimed fear-mongering. Josh Brown wrote a nice article about, all the people who are financially interested in capturing your attention through fear. One, the stock market is completely not looking like stagflationary 70s. And number two, look at the EPS in the S&P. Look at their earnings per share. Okay, so let's go back. This is the 10-year mark. So let me just make this simple, and rather than do forward earnings, so let's just do EPS and the S&P over CPI. Yes, prices are going up. They've been flat for 20 years, but they're finally going up. But look at the earnings per share in the S&P. $50 in earnings per share in the S&P. We were at half of that in 2014. You go back on the max reading, look at the growth in EPS. You can see, the stat starts to pick up here in the 80s. It was flat. It wasn't moving. Companies are making money. Not only that, we've shown this before, the margins in the S&P are growing at the same level. The margins are increasing. Companies are more efficient. They're making money, and that reflects it. And then we can go in the forward earnings. Let's bring in the forward estimate. It's going to be the same thing. Let me go out to 10 years to give you a little bit more scale. Look at where EPS estimates are next year, $55 a share. So what are you talking about? These companies are making tons of money. Yes, we have inflation going up, but I don't get where stagflation comes in. Do you have anything? Reel me back. Pull me back from the ledge here. I'm like, it's just like, it's another, I get, it makes it really difficult for investors to, I guess that's why financial advisors and portfolio managers are on the face of the planet to cipher through all this ridiculousness. But anyways, talk to me.
I mean, I can tell you're passionate about this, and that's good. And I don't think you give yourself enough credit calling yourself a simple man. But no, it's whether it's been stagflation and obviously even over the last couple weeks, the talk about a recession and slowing down of our economy. I mean, I think we would need to see, these companies are growing and they're doing really well right now, operating more efficiently, as you had said. And even with the recent pullback, as we're seeing right now, we were talking about how kind of the forward-looking earnings as a earnings per share basis as well are much more in line with having a more favorable market, more historical average of where prices are today. And so, I think the market, I think there's still reason for concern out there. I mean, as we're seeing what's going on in the globe across the world, there's got to be some levels of concern today. But as we take a step back and take a look at the bigger picture, I think these companies are more in line with where they should be priced, and the market looks a lot more favorable, certainly than it did at the start of the year and towards the end of 2021. Before everything happened with Russia and Ukraine, the market felt like it was kind of coming back to where it needed to be, and
Yep.
it felt like a pretty healthy pullback. Um, Correction, whatever it is. I think we're pretty close, or maybe we did hit a bear market in the Nasdaq last week or 2 weeks ago when we first hit like the high volatility. I think it's just shy of that today. Um,
But
from its all-time highs.
the arbitrary 20% we're in a bear market, yet
Exactly.
let's forget about the fact that we're up 100% since the
Right.
COVID lows. Like,
Right. Right. It,
but
it,
that's the accepted definition of a bear market, right?
no, and we're just in a new environment, in a new economy with, when you look around, and yes, maybe valuations have gone up higher than they need to be, and we've had that pullback, and
But
I
they
think
pulled
that
back.
they
Valuations
pulled back,
are
and I think
much
that was
more,
healthy.
yeah,
We're
yeah.
we're
I think
seeing, especially in the US, we're seeing just companies, like great companies, either continue to do well and be strong, or they're coming, new companies are coming to market. And we just have a really amazing, and part of the reason why we're, heavily and all invested in US companies right now versus overseas companies, we've seen this trend of the US companies, their market share on the global scale, because we have the best companies around the world. Like you're not seeing the growth from, some of these
100%.
overseas markets or companies like we're seeing in the US today, and we have a very healthy environment for that continued growth. So I'm still very optimistic in terms of where we're at. From an economic standpoint, obviously there's headwinds right now. There's no doubt about it. Um, you know, with everything that's happened the last 2 years, I think we're still in a position to, continue to do well and continue to grow. Um, Again, doesn't mean there's no need to be concerned. Obviously, everything that's happening is concerning, but I think there's a lot of support and a lot of, tailwind to kind of keep this thing moving along.
Yeah, yeah, yeah. Okay, I love it. I love it. And let's start to put some data behind this. So you threw up some stats which are interesting. Just talk about. Let's get in the guts of the market. So you mentioned the Nasdaq's off 20%. So technically, it's a bear. The bull market's over. We're in a bear market. Great. You made a note here. 70% of the Nasdaq is down over 20%, and 50% is down 50%. Do you want to talk about that quickly?
I think it's interesting in terms of, I don't think maybe the media, or you're hearing it as much as how bad some of the underlying, companies are, and maybe saying how bad they're doing isn't the right word, even though obviously with those numbers, yes, they're not doing well from a market price perspective. But we saw a lot of these, especially the technology, like the COVID darling stocks, if you will, just explode, and they came out like a rocket ship from the COVID lows. And as we're kind of normalizing and we're kind of getting through, especially the Omicron variant, we're seeing a pullback. And because the bigger companies that make up, again, the Alphabets of the world, Apple.
Hold on. Wait. Stop. Start again. What was the first one? I was just preparing this. What was the first one?
Oh,
You said Amazon?
Google,
Okay.
Alphabet, Amazon,
So,
Apple.
so here's Google. Okay. Let's do this exercise. I don't know. I'm kind of edgy today. I'm sorry. Everyone take a deep breath. Everyone who's watching live and at home.
Need a Snickers bar.
Snickers. What does that mean? I think it's
Isn't that from the
Thursday.
commercials that, someone would start acting crazy, give them a Snickers bar? and
Was
they
it a Snickers
calm
bar?
down?
Okay.
so.
I think you're, or an IPA. It's Thirsty
Either,
Thursday
yeah.
after we're done. So everyone take a deep breath. And Ryan just led this perfectly. Like, okay, here's Google on a monthly. Okay, that's Google. And let's throw Amazon in. Guys, I am I could get as in the weeds with technicals as pretty much anywhere in the world. I think those of you who know me from my past life would agree with that. But sometimes I just like to take a big step back. I love looking at pictures. Here's Amazon. What do you see here? If this was and it's always hard to work with log charts that bounce around. There's Amazon. It's been sideways for 2 years now. Pulled back, 10-for-1 stock split to $10 billion buyback. This one, I love this. I'm sort of trying to poke fun at the fear that's being spread in this market with the pace of information, and you have monthly charts that look like this. Their Apple is like, I don't know, $20 off the all-time high. 20% of 180 is less than, it's just around 10%, and it's up hundreds and hundreds and hundreds of percent. What else did you throw out there? Even Visa.
Microsoft, I guess. Yeah, Microsoft's, another one of the big ones. And, I think what people haven't noticed, because these companies make up so much of the major indices that we're focusing on, right? The S&P, the NASDAQ, and so much of that focus is on just what the index is doing. We haven't seen what's really kind of going on beneath the surface in some of these other companies that are just getting crushed. We might have talked about them before, not to call them out, but the companies that are being held in like
let's call them out,
like an ARC fund, right? In terms of you've seen how their prices have been hurt, and that's much different than what the NASDAQ has been doing as a whole. Because again, they're not they don't have the same allocation to some of these bigger companies. But I think we forget how much has been going on beneath the surface and how disrupted the markets have been. And to an extent, the NASDAQ, outside of the biggest companies that make up the index, is kind of in a bear market. However you want to price at, or whatever your levels are, but there's been a lot of companies not doing well. And that was before the war in Ukraine. And so I think kind of taking a step back and just realizing that, and understanding that, yes, there's maybe the indices are, the S&P is off maybe 12%, right, give or take right now. NASDAQ is almost down 20, but there's a lot of companies beneath the surface that are faring much worse right now. So
I say good. Like, I'm not a big believer in breadth. Like, this is how we offer value. This is how we produce alpha. This is how we separate ourselves from the passive buy and hold, because clearly that's not the kind of environment we're in. If you are attempting to continue to offer any kind of outperformance, why does every stock have to be above the average? And I have a chart that I want to show you. I'm going to spring on you. Like, why does every company that participates in the NASDAQ, which has got thousands, the NASDAQ comp, or the NDX, which only has 100 stock, why does everything need to participate? I don't understand. We trade cap-weighted indexes. That's where we measure our benchmarks. The companies that accumulate larger market capitalizations run more efficiently, make more money, and will rise to the top. I don't care about the companies that aren't performing and aren't meeting their numbers and can't adapt to the new world that we live in. As you said, Kathy Wood and Art, I still very much believe in her thesis. I think this is not the environment that we're seeing, where growth stocks with the promise of profits, or the hope of profits years down the line, can be bid up to such extreme multiples. We've seen a significant rotation into value, and I'm happy to say, Rye, we were there. We are there. We have in our growth portfolio, we have 3x the allocation to energy compared to the S&P. I mean, we're there, and provided that is going to be the kind of environment we're in, then we're just going to continue to do that. Let me just pull this over quickly, and then I want to go into sort of a breadth chart. Go ahead.
No, I was just going to say, I mean, especially coming out of the COVID lows, I think there was a lot more newer market participants. So when you see the Robin Hoods of the world,
right?
And
good point.
And I think, and I'm not saying that this was driving the market, but I just think there was a lot more voices within the markets, right? Whether in the media, if you were following on Facebook, Twitter, whatever it may be. I think there was a lot more market participants, especially when sports were shut down early on. People were kind of coming to the stock market to get a fix, right? Like, that's the reality of what had happened early on in COVID. And so we had this environment that stocks just shot through the roof. I don't know what they were up from the lows. I think 80, 90% probably. Like, and then
from when?
Some of those
when are you talking about?
From like the
from
March
COVID?
2020 lows until we, right around the peak at the end of 2021. I mean, over those 20 months or so, the market was up astronomically, and
Yeah.
some of the underlying growthier companies were up even more than that. I mean, they were doubling, tripling in size, and I think a lot of people forgot that. Yeah, like growth, and we're seeing it now. Having long-term returns and having outsized returns, it comes with a cost. And we've talked about this a little
Oh,
bit
for
in terms of
sure.
just having conversations with, as we talk to clients and prospects, having a long-term rate of return comes with a cost, and that is the ups and downs of the market. And you really can't avoid it. But I do think you can be, as we've talked about, tactical and strategic about how you're allocated in your portfolios, being really disciplined and sound in terms of making shifts, and not getting greedy with certain areas of the market, and being just sound in your principles of what you're doing and how you're approaching it. And that's never
You're
been
saying
more.
you can't have reward. You can't reap the reward without putting yourself in a position of risk. You have to be in the market, and unfortunately, we have clients who are coming to us who have just been cautious, and not all clients, some clients, but so many have come and they're waiting for the next shoe to drop, and they've missed out. New people are coming to us and saying, I've missed out on the significant rally, which, it breaks my heart to see. But now it's even worse because now this is the time where the market's pulling back. Now we're all of a sudden seeing inflation. Not only if you're not participating in the market and not fending off, you're losing 5, 6, 7% per year with inflation. So, and I looked at our fixed income portfolio, probably down about 3% here year to date in the fixed income portfolio. It's unfortunate. We have to put yourself in a position where you can make money, and the only way right now, and we've seen crypto. Crypto is clearly not an inflation hedge. I put a tweet out overlaying SMH, which I do want to talk about quickly, and I know you have to get out of here soon. Crypto, Bitcoin overlaid on SMH. It's a very, very close correlation. It's the currency of the new age. If and when AI, VR, and I forgot my other two-digit acronym for virtual reality, augmented reality, and AI. Crypto, Bitcoin, some derivation, some project is going to be the currency that we exchange, and they'll have its time, but it's not an inflation hedge. So right now, inflation is driving the market. We continue to be pretty significantly overweight. This is our growth portfolio, and I'll show you our sector weightings right now. Energy, we're at 11.7% in the growth portfolio. And I say this every time, but I don't care. I'm going to say it again. If you told me we're going to launch this RAA, this wealth management ride with triple the weighting of energy in our growth portfolio, I would have said you're partaking in the cannabis stocks product too much. So we're at 4.25, which has actually come up quite a bit in the S&P. So we're at 11 and change right there. The comms is fine right there. We're also at 11.2% in financials, which again, for a growth portfolio, that's market weight. Growth portfolio in the Todd Gordon world, those of you who've been trading with me and following, I've been long all tech for 3-4 years straight. And, to have 11% in the growth portfolio compared to the S&P's 13, I think is remarkable. And I love the pullback in financials. People are saying, financials are selling off. We still have the yield curve inversion. We still have a normally shaped yield curve. I want to talk about that super quick. I want to pull up a quick guts chart of the NASDAQ, and then we'll move in. Let's talk about that real quick, if you don't mind. A lot of people are talking about the yield curve, and Ryan and I were going through this. I love this dynamic yield curve chart from stockcharts.com. Really, really good. So what you're looking at here is short term. This is the Fed funds down here, down in the 3-month area, all the way up to the 30-year. And a normal shaped yield curve is this. Okay, low short-term rates, high long-term rates. That's going to benefit, obviously, the overall economy, but specifically financials as they borrow. Okay, no problem. as they borrow in the short term, lend in the long term. And what happens here is what you're seeing is sort of a bellying out of the middle part of the curve. You're getting 2s, 5s, 7s, 10s sort of flattening, but the short term where the Fed is acting, even if they raise 50 to 75 to 100 to 175 basis points, I think the whole curve is going to shift up, maintaining that steep sort of this normal shaped yield curve. It's a long ways away from yield curve inversion, look like that in 2007 and like that in 2000. So we're a long ways away from there. Right, I know you have to hop. You've got an appointment. Do you want me to keep going, or do you trust me? Do you want me to turn off the lights when I leave, or what do you want to do?
I think we got into a lot today. We had so much we wanted to cover anyways, and there's just so much in the news right now. I think if there's anything pressing that kind of goes along with what we've talked about,
yeah,
finish it off there, and I think we'll have a lot to discuss into the weekend and next week as well. Any of these trends that can be kind of longer term that can wait to next week. Let's
this is hot. This has got to pop right now, baby. This is super quick. Talking about the oversold nature of the NASDAQ, this is a fun chart. NASDAQ stocks below the 200-day moving average. And what happened is, this is kind of getting into my old life a lot. I like to look for patterns and relationships and similarities, and basically all three of these blue lines. So this is the percent of stocks in the NASDAQ below 200-day, 19, 2020. All three, the decline from about 70% down to 15%. Call it roughly, a 55% drop. We've seen it once. It's the exact same distance here in this blue line, and we just saw another 55% drop. So roughly, when you have a pretty good market correction over the last couple years, you'll see a drop from a decline of about 50 to 60% of stocks that were above the 200 go below the 200. We're now at this equal leg relationship. So we're starting to see a very oversold nature in the NASDAQ, even though earlier I said I don't care. Every NASDAQ stock does not need to participate in the uptrend. And we looked at those longer term charts. So continuing to be bullish. We like our sector allocations. We are rebalancing as needed. We're not an actively trading portfolio management style. We are in the market. We will lighten up when needed, but we want to be in the sectors that are outperforming. And in this kind of dynamic market environment with such inflationary and geopolitical pressures, it's important to be in the right stocks. And we work really hard to do that, as well as Ryan taking care of the financial planning. So check us out at newAgeWealth.com. We have disclosures below in the show notes. Please check that out and let us know if we can help you. Otherwise, we'll see you next Thursday. Ryan, closing thoughts.
You covered it, man. I got to run to my oldest. He just started Kung Fu last week, and so we moved this up a little bit earlier today, just before market close. But I think we able to cover everything. The markets bounced back at the end. They're still down, but they look a lot better than they did, maybe an hour before close. So all good heading into Friday. Excited for I can't believe it's already end of day Thursday heading into Friday, but excited for what we're doing, and it was a great show today.
Yeah, man. Enjoyed it a lot. Thanks a lot, and I'll talk to you later. Viewers, thanks so much. Please hit that thumbs up button, drop a question, comment, insult if you want below, and we'll catch you next Thursday, okay?
All right. See ya.
See you guys.